Hi everyone, thanks for joining us. My name is Chris Ashton. The title for today's webinar is Technical Analysis Tools Traders Use in Volatile Markets. Now, I thought this would be a good topic to focus on considering the moves that have been seen across all CFDs since my last webinar just 6 weeks ago. President Trump and his team have been keeping us all on our toes with his approach to trade tariffs, the US economy and geopolitics. In today's webinar, I want to look at how technical analysis techniques can support our decision-making when trading during such volatile periods. Before we move forward, just a few housekeeping points. The webinar today will last approximately 20 minutes. There will be a Q&A section at the end, so feel free to add your questions to the Zoom chat or Q&A section that you have access to. Richard Adcock, the Corellian Technical Analysis Mentor, is with me to help answer those questions. And please note that trading CFDs involves risk, and this session is for educational purposes only. It is not financial advice. On screen for you now is what I'll cover today. First, I'm going to talk briefly about risk management and stop-loss guidelines when trading in volatile markets. I'll then move on to discussing Bollinger Bands, specifically how they can be useful in helping to establish the directional risk of the CFD that you may be focused on, and how they can be used to gauge increasing volatility in CFD prices. I'll then move on to discuss how an indicator that is on your Plus500 platform called the Stochastics can be utilized to help trade trade entry and trade exit. And then I'll finish by looking back at a case study of gold from April and outline how we could have applied these techniques to trading this popular CFD by combining the two indicators to aid decision-making within increasingly volatile conditions. Okay, let's get started. Risk management is very important when trading in volatile markets. As traders, we must be aware that during these periods, the risk of sharp and aggressive price moves is much greater. While this may provide opportunities for increased profits, if positioned correctly, it can also increase the potential for big losses if risks aren't managed effectively. As such, it can be helpful to think about setting yourself some clear rules to follow when trading during volatile periods, and these may help you to reduce some of the possible risks. One thing to consider is utilizing a stop loss to protect your capital as soon as you execute your trade entry. A stop loss order automatically cuts your position when a predetermined price is hit, capping your losses. This can help to protect you against rapid price fluctuations or an unexpected reversal in the price of the CFD that you are trading. Helpfully, these orders can be set in advance on the Plus500 platform. Technical analysis can also be used to help you with stop-loss placement. The best practice, if you are long of a particular CFD, is to consider placing a stop-loss under a valid support level, such as a last correction low or rally point in price that you have identified. While if you are short of a particular CFD, best practice is to consider placing your stop loss above a valid resistance level, such as a previous recovery high or a correction in price. Now, this can provide some challenges where the amount that you are willing to risk or lose on a trade doesn't match with the level that you've identified for your stop loss placement. In this situation, you may need to consider adjusting the size of your position to provide you with enough capital to ensure that your stop loss is placed below the support or above the resistance level that you have identified as meaningful. Remember, you don't want to be stopped out at an arbitrary level due to a random price fluctuation before the CFD that you're trading resumes movement in the direction that you originally anticipated. This can hurt your confidence as well as negatively impacting your trading capital. Following on from this, when markets become more volatile, best practice dictates that this extra volatility needs to be accounted for. So it's important to be aware that you may need to consider placing your stop loss further away than you would have set it in normal market conditions, which again may lead to you adjusting position size to accommodate wider stop loss parameters. However, the other side of this is that you should also consider wider take profit order parameters as well to account for this increased volatility and to offer a more balanced risk reward profile. Trading in volatile markets can be difficult, but by considering these simple stop loss rules, you may find it easier to navigate your way through these uncertain trading conditions. Okay, so now let's move on to discuss how technical analysis may support your trading when these conditions get more and more volatile. So as we said, market volatility is a concept every trader must be aware of and understand to make informed trading decisions. Volatility can be caused by many factors, including economic events, geopolitical concerns, or has been the case recently, an increase in global trade tensions after the introduction of higher tariffs on goods imported into the US. Technical analysis can be helpful to assess risks during these volatile periods in several ways. The first example, it can be used to identify support and resistance levels when using the price charts on the Plus500 platform, and these can help to determine if important levels are being broken, which may suggest a more extended price move in the direction of the break. Or in the case where an identified support level holds a sell-off in the price of a particular CFD, or a resistance level manages to cap a rally, prices may recover back in the opposite direction. We have previously covered support and resistance as well as price trends in a previous webinar, so please look on the Plus500 YouTube channel to watch this if you haven't already. You may find it helpful. Now, technical analysis also provides us with several indicators that can help us to navigate volatile markets by gauging the current level of market volatility and even offering an insight into the timing of trades within these conditions. A real advantage of technical analysis is its ability to help traders determine whether a particular CFD is in an uptrend, a downtrend, or is moving sideways. Being able to establish these trends, even within a volatile market, can enable traders to align their strategies and trades with the market's direction. A great indicator to help us determine both the trend's direction and current price volatility of a particular CFD is Bollinger Bands. So what are Bollinger Bands? Well, a Bollinger Band, simply put, is a moving average envelope that consists of three lines: a simple 20-period moving average, which is called the mid-average, and the lines above and below the mid-average that are called the upper and lower bands. And you can see these highlighted on the dollar-yen chart that is on screen right now. It is the mid-average that offers clues to the direction of the trend of the CFD that you're looking at. If it is rising, the CFD's price is classed as being in an uptrend. If it is falling, the price is considered to be in a downtrend, while if the average is flat, a sideways trend is evident. Using this gold chart that's on screen as an example, within a sideways trend, when the mid-average is flat, we will see prices moving either side of the mid-average, with the bands parallel to each other and the average. In this setup, the upper band can act as a resistance level to price strength, and the lower band can act as support to price weakness. This may provide opportunities to trade the range, where long positions are established just above the support provided by the lower band, with positions closed and then reversed, potentially just under the resistance marked by the upper band. In this situation, best practice is to place a stop loss on short positions just above the upper band resistance and stop losses on long positions just below the lower band support, as moves through these levels may suggest a price breakout and the start of a more sustained period of price action in the direction of the break. Now, in the situation where a sideways range is forming, volatility is stable, and the sideways range will likely extend further until a closing price breakout is seen. However, because of the formula and the calculation used, Bollinger Bands also highlight volatility in CFD prices, making them a useful indicator during conditions like we've seen in the last 6 weeks. If price volatility is increasing, be it to the up or the downside, the bands start to widen. If the mid-average is also rising while volatility is increasing, the conclusion is that an uptrend in price is evident, and because volatility is increasing within that uptrend as the bands are widening, the uptrend can extend further. Now, when considering a downtrend, this will be reflected by a falling mid-average with increasing price volatility signaled by the widening Bollinger Bands. In this situation, the conclusion is the current downtrend can continue because we're seeing increasing volatility within that downtrend, which is likely to remain in place until volatility starts to ease, which is when the bands draw together or contract, as you can see on the screen. Knowing this as traders, we can account for this in our trading strategies. We can look to take advantage of these periods of increasing volatility because this is when the potential is greater for price movement within the direction of the trend. When we have a confirmed uptrend or downtrend alongside increasing volatility, we can look to be long of a CFD in an uptrend or short the CFD in a downtrend and continue to hold that position until we have signs within Bollinger Bands of a consolidation signal, which is when the bands contract. It's at this point that we may want to consider reducing or even closing our live position and observe what happens next. Now, one thing that you may also notice when using Bollinger Bands in your trading are periods where the mid-average is either rising or falling to reflect the direction of the trend, but the Bollinger Bands, while moving in the direction of the trend, are parallel to each other. Basically, they're not widening. While this reflects an uptrend or downtrend being evident in the price of that particular CFD that you're looking at, because the bands aren't widening, it means that volatility is steady and not increasing. It may mean that while a CFD's price can move in the direction of the ongoing trend, the actual movement is likely to be less aggressive in nature because we aren't seeing that increase in volatility. When observing this type of Bollinger Band setup within an uptrend where the mid-average is rising, prices can find support at the mid-average and resistance is offered by the upper band. And this can be seen on screen right now. From a trading perspective, we may look to go long of the CFD against the support offered by the rising mid-average, looking to close out the position as prices approach the resistance marked by the upper band. Now, in a downtrend where the mid-average is falling, resistance is encountered at the mid-average and support is offered by the lower band. From a trading perspective, we might look to go short of the CFD against the resistance offered by the falling mid-average, looking to close out the position as prices approach the support marked by the lower band. Now, as we finish the Bollinger Band section, a final thought is when trading, being able to gauge when high or low volatility periods are taking place can be very useful for traders, so positions can be adjusted accordingly. So it may be worthwhile considering introducing these into your trading, even if you practice using them on Plus500's excellent live demo platform. On screen right now, I've summarized the key points on Bollinger Bands for you to take note of or take a screenshot of if you wish for future reference. Now, as we move on, while Bollinger Bands can be very useful in determining the trend, direction, and increasing price volatility for a particular CFD, if we are looking for some insight into when price is set to resume a trend that may lead into periods of increased volatility, we can look at deploying the stochastics indicator. This indicator is based on a momentum of price movement, which means it reflects the speed of price moves. The indicator is made up of two lines, the indicator line, which is the blue line on the chart on screen, and a 3-period moving average of the indicator line, which is the red line that you can see on screen. The indicator ranges from from 0 to 100, and the calculation takes the current price level of the CFD that you're looking at in relation to its range over the last 14 periods. The good news is that 14 periods is the default setting within your Plus500 charting system. Now, the stochastics indicator is often most useful as a tool to help time the execution of a trade. As prices rise, the indicator line rises above its average and the CFD is said to have positive momentum, suggesting risks are increasing for moves to higher levels. As prices fall, the indicator line falls below its average and the CFD is said to have negative momentum, suggesting risk of prices moving to lower levels. From a trading perspective, we might want to look at being long of CFDs that have positive momentum and short of CFDs that have negative momentum, as this reflects the immediate directional risks within the price activity. To emphasize this, let's look at the daily chart of gold from the beginning of the year. I've used arrows to show where the stochastics indicator highlighted a turn higher in momentum, suggesting the price of gold is and its strength is resuming to extend what is a positive uptrend. As you can see, as the blue indicator line crossed above the red average, the price of gold moved higher again. Again, before I move on to the next section, I've summarized the key points on the stochastics indicator for you to take note of or take a screenshot of if you wish for future reference. Now, Bollinger Bands and the stochastics indicator can be used individually to provide signals to support your decision making, or they can be combined. To show you this, how this can be done and to highlight what it could have shown you, I'm going to run through a case study of gold during April using a 4-hour chart. In this example, I'm going to use the direction of the Bollinger mid-average to establish the price trend. And as you can see from the chart on screen, the Bollinger mid-average is rising, telling me gold is in an uptrend. I'm also watching to see if the bands are widening, reflecting increasing price volatility within that trend, which may suggest a more extended move in the gold price. In this example, they do widen, reflecting increasing positive volatility within the uptrend. This lets me know that gold's price strength can be more prolonged and may rise even faster than might be expected, allowing me to take advantage of this more extended advance in price. The stochastics indicator helps provide me with a timing signal within the trend, crossing higher on the 8th and 9th of April, allowing me to be prepared to enter that long position. Once long, I'm then watching for if and when Bollinger Bands start to contract, which informs me that volatility is decreasing and that the gold price may be entering a period of consolidation. It is at this point that I can decide whether to consider closing my long gold CFD position and prepare for my next trade. Now, once a price consolidation is seen, either momentum then crosses higher again to resume the positive price trend, which in gold, which provides me with an opportunity to re-enter a long position. And you can see on screen right now. Or price breaks below the mid-average as seen towards the end of April, where I would then be watching to see if that mid-average starts to turn lower, which would suggest a downtrend may be starting to emerge for gold prices. Then it's at this time that I would look for crosses lower in the stochastics indicator within the new downtrend that suggests price weakness is resuming, while also checking to see if the bands are widening, which could let me know if the move down could be quicker and extend further than initially expected. In conclusion, Bollinger Bands and the stochastics indicator can be used separately or combined to provide us with a stronger insight into the trending condition of a CFD, when momentum is turning positive or negative within that trend, and when volatility is increasing within the trend, to allow us to adjust our trading strategies accordingly. Today, we've looked at both daily and now 4-hourly charts, but these indicators can be used over any time frame that you trade. The signals that I've discussed today will still be the same. Okay, so that's the end of this technical analysis part of the presentation. Let's at and take some of your questions. And obviously Richard's here to help me with those as well.